what's been unfolding in the commercial real estate space in the US is each property type responds at a different time lag to higher interest rates. And the first area where we can see this actually is in the residential housing market, single family homes. And so the average 30-year fixed rate is at highs that we haven't seen since the year 2000, and the average number of monthly mortgage applications is back to lows we haven't seen since 1995. So, and looking at interest rate implications for real estate, the residential housing is the first to get hit. And then as we look to multifamily, that gets hit next because you have to take your decelerating rent growth every 12 months. You can't lock up your term like you can for 5 or 10 years, like an office or an industrial building. And so we saw rents growing in the multifamily space between 20 and even 40% in some of these markets. And now it's decelerating. And as a nation, we're sitting at about 1%. You have cap rates that are rising to meet the new kind of debt markets and expectations of the debt markets, but then also you can no longer go negative leverage. So you have this kind of double whammy that's driven cap rates in the multifamily space from the low to mid threes to now into the fives, and we could see that go into the sixes going forward. The office standpoint is a different story. The challenges there started in 2014, 2015 as capital moved away from that sector. It's very expensive to own below the line. The challenge for office today is to be able to get debt. And so that's where we do see demand where investors do want to buy office, but just not at these prices. And their inability to find debt outside of seller financing makes it incredibly difficult. And so you're seeing valuations in the office space down over 20% as a result. And we're seeing in some cases major assets in primary markets down even more, trading for 50 cents on the dollar or even less. So when you look and you kind of pivot to the other asset classes and you think about retail and industrial, they're very heavily tied to the US consumer. And despite cap rates being up 50 to 75 basis points, maybe 100 basis points, the rent growth has more than offset that. So you're seeing very little price depreciation in the retail space, maybe high single digits, low double digits. And then industrial, I would say, is probably the favorite asset class today, where we saw very strong rent growth that held for a long time in the low to mid teens. It's still in the high single digits today. And so because we've had this continued, double digit rent growth now for going on 4 years, there are real mark to market opportunities in the markets. The world is starting to change in the back half of 2023. And my thought process for the next 12 to 18 months is there'll be a shift away from hyper-focused interest rate analysis into focus on the balance sheets of our tenants and the U.S. consumer to support continued demand going forward.